All right, Scott. So getting right into it here, would love to have our listeners and viewers know a little bit more about Scott Dostal, where you're from, and maybe a little bit of history of Atlantic Prime.
Sure. Well, I've been in the business 20 plus years. Been at Atlantic Prime close to 3 years. I moved down here to the Rehoboth area about 15 years ago. Got a lovely wife, Tammy, who also works for the company. My two boys go to Sussex Academy in Delaware, both golfers.
Yeah. So golfers, with that, are you doing some traveling? Are you doing, what are the ages of the kids?
Kids are 13 and 15.
Busy.
Busy. Yeah. Right now they're involved with basketball, so we've got that going on.
Yeah. Yeah, I know those years. I've got a 13 and 15-year-old as well, and it's go time, and they're getting ready to just transition there into the high school years and in a whole new world of fun.
Yep.
So you're busy with that. You've got a great business going with Atlantic Prime. Well, I think one of the things that is unique is you have locations not just here on the shore, but you also have a presence back in Annapolis. Is that correct?
Yeah, we've got an office in Lewis, Delaware, right in Five Points. We also have an office right in Annapolis on West Street. Business has been around for 5+ years. I've got two other partners, and we've got two other employees down here in Lewis, and about 3 employees back in the Annapolis area. Not only are we a broker, but we're also a direct lender, where we lend our own funds and close in our own name, which helps us control the process on all of our transactions.
Yeah, absolutely. So we were introduced through a mutual friend, in the finance world, and with that, that helps to build that trust. But I will say, being in the business 21 years. Over the years, I've worked with a number of different lenders, and for real estate agents, one of the biggest keys is having a partner you can trust, that is going to have great products, that's going to do a good job, is going to communicate to the clients. And I've definitely found you to check all of those boxes, which has been fantastic. But the partner piece, you mentioned direct lender, and being at the beach, we sometimes have unique properties that direct lender piece, I think, can benefit. Can you talk a little bit more about that?
Yeah, condo financing is a little different than your typical single family home, because not only is a lender approving you, they're also approving the condo project.
Right.
So we've sort of streamlined that process where in certain situations we don't get a full condo questionnaire. We don't go through the full budget. We don't go through a lot of things that, say, a Fannie Mae or Freddie Mac lender might go through. Since we don't sell all of our loans to Fannie or Freddie, we sell them to certain banks. We don't have to go through that strict process where you're looking at investor concentration, or if a budget's a little off, we don't worry about that.
Got it. So I get 100% what that means and the benefit to it. But our clients, a lot of times our clients, sometimes this is their first purchase of a second home,
Mm-hmm.
and they don't even know what that means. Maybe you can go into that a little bit. Like, what is the benefit to having more of a streamlined process?
The benefit is knowing somebody who knows the market, who knows second homes and knows condos. Me doing this the last 20+ years, being down in Rehoboth area, I finance hundreds of condos over those years. So I've learned a lot about condos, about the process, the different guidelines that Fannie and Freddie Mac require. In different, that's why we've created our own products, because we don't have to follow Fannie Freddie guidelines when it comes to lending on a condo.
So it's more streamlined.
Exactly, very very streamlined. We don't go into a lot of the documentation that your typical lender in the Rehoboth or condo area will require.
Yeah. So I think as a consumer, it just makes the process probably a little bit more enjoyable.
Process easier on them, also easier on us as well.
Right. So second home condos has been kind of our bread and butter, especially in the Ocean City market, and that's where it's just so key trying to find that partner that can really support our clients, and you're definitely able to do that. I think the first time we actually met, the first transaction we worked on together was actually a VA deal, a veterans loan. Maybe you can talk a little bit about your products there.
Yeah, we have all different kinds of projects, one being VA, which is 100% financing. With VA, The borrower does have to occupy the property as his primary residence. There's zero money down on VA financing. Also, there's no PMI or private mortgage insurance. One of the benefits of doing a VA loan is they can put zero money down and get into the house with a great rate.
Right. Obviously have to be a veteran.
Obviously have to be a veteran, or a spouse of a veteran.
Okay. And we talked recently here. I think for myself, this was even a misconception I had, or a myth that I had, is that a VA is really not going to work for condos. It's predominantly a single family home product, but I guess it does work sometimes.
You can do condos. When doing a VA condo, the project does have to be VA approved. We've actually helped borrowers. In fact, one project in Rehoboth Beach, which is Canal Corcoran, we actually got that project fully approved with the VA for our one specific borrower. So we can definitely help with that. As long as the project meets VA guidelines, we are willing to take those steps to help a borrower get into that unit if they want to buy there.
Got it. So like guideline examples might be rentals,
investor concentration. Make sure there's not more than 51% investor concentration. Make sure that the budget meets VA guidelines, but that's a very long conversation. We want to get into all the specifics about budgets and bylaws and everything of a condo association. But we've done it in the past, and we'll do it again if a borrower wants to be in a specific project. We're happy to help.
Yeah, we don't see it very often in our marketplace, but it's good to know that you have the possibility of being able to do that if we need it.
Yeah, most of our buyers down here, they're buying second homes. So again, the thing about VA is it does have to be an owner-occupied property.
Right. So one of I talked about in the intro here that the market has obviously shifted. We've seen some changes. We're continuing to see changes, and a lot of that has to do with interest rates. Mm-hmm. So I mentioned there that you've got some products I think that kind of help combat those interest rates, and maybe you can go into some of those products, what you have and what could benefit a buyer.
Sure. Again, we don't sell all of our loans to Fannie or Freddie. We sell them to certain investors where we don't have certain add-ons that those larger banks, say Wells Fargo or Bank of America, might have when it comes to buying a second home. There are certain loan level price adjustments that Fannie and Freddie came out with in April of last year, which takes a second home mortgage rate from 5.5% to 7.5%, because before April of last year, a second home rate used to be the same as a primary or owner-occupied residence. Now rates are similar when you're selling your loans to Fannie or Freddie. They're very similar to an investment property. So you've got somebody putting down 20% on a second home. They're not going to get that same rate as a primary residence like they did in the past. They're going to be paying close to investment property rates. So.
Got it. That's normally what they pay, correct? And then you have products that are a little bit different.
We have products actually, because we don't sell all of our loans to Fannie and Freddie, where if I've got a client putting down 20%, we have no add-ons. Our rates are the exact same as a owner-occupied property or a second home.
Yeah, which is huge.
It is. Our rates now are below 6% for our ARM products, and we see a lot of the second home buyers taking advantage of it.
So the ARM product, been doing this for a while. That used to be kind of like a taboo word. We didn't get into ARMs. That was something that people were scared of. But maybe you can shed some light on why they might consider it now.
Yeah, our ARMs. We offer 5, 7, and 10-1 ARMs, whatever's best for the client. What happened in the past in the 2008 meltdown is you had a lot of ARM products that people were putting down 5%. They would adjust a year later. Where if you've got a 10-year ARM, that rate is fixed for 10 years. It can't go up. It can't go down. It's fixed for 10 years. And the average person is probably going to refinance or sell their home in less than 10 years anyway. So, it still amortizes over 30 years. So it's just like doing a 30-year fixed for 10 years.
Got it. And then is there caps on how much it could go up? Obviously, we're not going to see most people wait 10 years. They're probably going to refinance. But when you get to year 10, and it makes an adjustment, is there a cap on how much they can go up or down in that period?
Yeah.
It depends on the product.
Very good question. The max it can go up per year would be 2%, and the max it could be at the end of the life of the loan would be, after all the rate increases, would be 5%. So, for example, if your rate is 5.5% that you start out with, the max it could be would be 10.5%. And it can only go up 2% per year.
Got it. And then same thing going down. Is there caps that way, or can it adjust down? It hasn't happened in a while, so
it can adjust down. It's based on the 10-year Treasury. So depending on what the margin is at that time, it could go back down, but it can't go below your floor rate, which would be currently say 5.5%.
okay, got it. Another, so that's huge. We get that conversation every day, or that question every day, is what's going on with rates? Where are rates today? And it's amazing how some people just they've heard rates have gone up, but then they don't really necessarily think about it until they go to look at their monthly payment, right? And
Correct.
They're ready to make a move on something.
It's hard to tell with this economy what's going to happen with rates in the future. I mean, you've got economists saying, hey, they're going to get back down, but I don't think we're ever going to see 2.5% rates again in the near future. But I could be wrong, and hopefully I am wrong.
Yeah. Well, for the time being, you certainly have a product that is unique. You can get somebody into a second home condo at a rate that's just, it's not common out there. So that's where why we're happy to partner with you. I did want to just touch on this too. This is another myth, and I think maybe if you can start with second homes and what's expected, but then what is, like, for a primary resident, for the longest time everybody said, hey, 20% down. You need 20% down. Is that the truth? I mean, or can people put less down? And what does that mean?
We can do less down. I mean, most of our second home products, most of our clients will put down 20%, especially if they're buying a condo. But if somebody's buying an owner-occupied property, we can do as little as 3% down, 5% down. Where interest rates are right now, where prime is going up so fast, we used to do, piggyback second on a mortgage, where we do a first at 80% and a second, say, for 15% to eliminate the PMI. But with prime going as high as it has, it's almost more beneficial for someone to do a 95% mortgage and have a very low MI payment instead of having a second mortgage that, say, for example, is between 8 and 11%. So.
Got it. Yeah, we did see that flash across the radar a little bit, where some credit unions or some of these other companies would come in and do that second mortgage a little bit, but obviously, with prime going up, that's going to push those rates a little higher, and the blended probably just doesn't make sense.
The blended rate doesn't make sense. I mean, we also have some products too, where if somebody wants to put down 10% or say 5%, we can always buy out what they call the PMI or mortgage insurance, where they take a slightly higher rate, where they're not paying mortgage insurance whatsoever.
So my next question here, Scott, is, for our buyers, like, when should they start this process? What is the first thing they should do if they're considering buying a second home or an investment property, or this is their first purchase of a home? When should they start that process? And maybe you can kind of go into some of the things that you go over with them from a kind of a counseling standpoint.
Sure. What I recommend is, if they're local, we can always set up a time to meet them in person, especially first-time home buyers. We like to do that. A lot of our buyers down here are buying second homes, so a lot will go to our website and do an application online. But we do have weekend hours, and we do work late some nights, so we don't mind meeting people face-to-face if they do want to sit down with us. Once they do the application, we take a look at the income, take a look at the credit. I might make some suggestions on what to do for their credit if it needs improvement. As far as income, I mean, we do have a lot of borrowers moving down here, say from other states, who are recently retired, where they might not have a full-time job or a W-2 income. We can actually use retirement income to help that borrower qualify. So, for example, if they've got X amount of dollars in their 401k or retirement account, we can just set up a draw where that draw is enough for them to qualify to purchase the new home.
Got it. Yeah, we've come across that a few times here, where they're just at a point where they've got great retirement, but just don't have that income coming in. So you can certainly reverse engineer that and make that work.
Yeah, we've done it on several occasions.
Okay. The old thing that we used to say is don't go out and buy a car, don't make any big purchases. Does that still hold true in today's world?
It depends on the buyer. I mean, we've got down here, we've got a lot of buyers who are buying $1 million properties who qualify very easily. We have some first-time home buyers who we will tell not to go out and make any big purchases, any boats or trailers or RVs. But I guess it's different with each specific borrower. We'll go through that specific scenario for the borrower and let them know what they should not do.
Got it. And then, this is something too, I don't see a ton, but the self-employed borrower, the self-employed buyer, what types of products do you have there? Or what types of things should they be thinking about?
Sure. We deal with a lot of self-employed borrowers buying here at the beach. We have what they call non-QM loans, which are non-qualified mortgages, where we can take a look at a client's bank statement, his business bank statement for the last 12 months. If the business looks like it's doing well, we can finance that. Even though the borrower might not show a lot of money on his tax return, we can do a non-QM loan, which we do quite a few of those.
Yeah, I would imagine. I mean, so many of our buyers just in general have their own businesses back home, but then our local, environment here, so there's a lot of people in the service industry, and
we do waitresses as well. I mean, not everybody wants to pay Uncle Sam, so we have programs out there to help those borrowers that do that.
Got it. One other thought that comes to mind, especially in Delaware, we have so much new construction. Mm-hmm. There's all these. It seems like everywhere you drive in Sussex County right now, you're seeing some new construction popping up. I know you do a fair amount with new construction. Anything special there?
Think about new construction. We can actually do long-term rate locks. One thing I suggest about new construction, though, is definitely have somewhat of a settlement date from your builder, because we have seen some delays with several of the builders in Sussex County lately, just for whatever reason, transformers, garage doors, anything. But we do a lot of new construction. We're one of the preferred lenders for one of the biggest builders in Sussex County, which is Capstone Homes. We do a lot of financing for them. And with rates creeping up as fast as they did, one thing we can offer with the builder, which we do, is we offer what they call a 2-1 buy down. So what that means is, say if the current rate right now is 6%, the builder or the seller can help offset that payment by paying a seller concession. By the first year, your rate would not be 6%. It would be 2% below that, or 4%. The second year, 5%. And then the third through 30th year, of course, the full rate, which would be 6%. Basically sort of an inflation guard with rates rising as fast as they did in recent months.
And can you refinance that early?
You could refinance that at any time.
Okay.
We have no prepayment penalty on any of our mortgages.
Got it. Well, certainly a ton of different options, and as a real estate agent, I just try to dip my toe in a little bit, know enough to kind of help guide the client. But I mean, my thought as an agent is put them in touch with you. If we have somebody who's looking to do something, I know a little bit, but I'd rather have them talk to you and kind of go over what might fit their needs the best as kind of a first step. So
thank you.
Yeah. Well, I really appreciate you coming in here today. Is there anything else you want to add? Anything else you want to touch on?
No, just we're always available. Can be reached at 240-475-4741, or go to our website, RehobothBeachMortgages.com.
That's awesome. Well, Scott, here's to a great 2023. We are early in the year, looking forward to having an awesome year and working together and continue to grow our partnership. So thanks for stopping by.
Thanks, Ryan.
All right. Until the next time, we'll see you.